Hi guys, welcome back. So everyone is watching Intuitive Surgical right now. Their new Da Vinci 5 system is making headlines. Their market share is massive and Wall Street loves them. But here's the thing. What if the real story in surgical robotics isn't about the robots at all? What if the company that is quietly behind them doesn't even focus on hardware? In this video, I will dive into two very different players in this booming market. Intuitive, the industry giant, and Surgical Science Sweden, a tiny and unknown company that is quietly powering the software and simulations behind the scenes. One builds the machines, the other teaches them how to work. Let's see which one has the bigger upside and has the better score in my Quant rating system. And as a small spoiler, I am already invested in one of them and plan to further increase my position in them soon. And if you're new here, my name is Florian. Thank you for joining me today. The general markets for industrial robots is booming and should grow with a CAGR of around 10% until 2030, as this market research from Grandview Research shows. But with this expectation, they are on the lower end of the forecast for this market. In my research, I found growth rates of up to 18% per year until 2034. The field of surgical robots should grow at roughly the same rate. Grandview sees a growth of 9.2% annually until 2033. But again, there are others who see the yearly growth rates much higher and actually closer to 20%, like GMI with over 17% here. Jensen Huang, Nvidia CEO, is recently also talking more and more about the robotic revolution that he believes is closer than we think and might even begin in the next 5 years. And he also thinks that the first widely used robots will be for well-defined tasks in controlled environment like factories. But guess what is also a controlled environment with well-defined tasks? Hospitals, exactly. And even if the concrete numbers are a bit uncertain, the consensus still is that this market should grow with at least low double-digit growth rates for the foreseeable future. And I, for my part, like to invest in such growing markets because, as Charlie Munger once said, go fishing where the fish are. I just think it's much easier to find growing companies in markets with secular trends. And luckily for us, there are not so many fish in the surgical robotics field yet. There are only a handful of companies that are currently providing these surgical robots. And Intuitive Surgical is by far the biggest one, with an estimated market share of around 60%. And they are also not sitting on their hands, but rather do everything to further strengthen their position. Just earlier this year, they announced that the 5th generation of their main system, the Da Vinci 5, just got the FDA clearance. This includes new controllers for improved precision with vibration and tremor controls included, a new 3D display with higher resolution, as well as force feedback technology to let the surgeons feel what is going on. And of course, the computing power of these systems was also improved. In fact, it was even improved by 10,000 times compared to the Da Vinci Xi, which gives them the option to add new apps and tools to their systems and keep the software ecosystem pretty flexible. And just a couple of days ago, the first batch of these added software features received the FDA clearance, which included a force gauge to display the force that is being applied, an in-console video replay, and network CCM to enable software updates to be processed remotely. With these innovations, Intuitive could boost the sale of their Da Vinci 5 systems to 180 systems in the last quarter, which is over double the amount that they sold in their second quarter last year. And this is only the beginning, because up to now, Intuitive was only allowed to sell these new systems in the US. But just in June and July, they also got the EU certification for the Da Vinci 5 as well as the regulatory clearance for Japan. And with this, they should be able to continue or probably even accelerate their growth of installed systems. In the last 5 years, this installed base did grow by 15% every year. This is for all of the systems though, not just the Da Vinci 5. At the same time, the procedure that were done with these robots grew even quicker, with an average 17% annually. And this is especially important for us investors. Because when we look at the revenue trend, we see that these system sales or leases only make up a very small and shrinking portion of Intuitive's revenue. The far larger part comes from instruments and accessories that are used for each procedure. With this, the recurring portion of the revenue is also constantly increasing. I like such business models with a large portion of recurring revenue due to usables or subscriptions a lot. Because, first of all, it gives the company nice lock-in effects and thus a moat. And second, it makes the revenue more predictable because we already know what to expect roughly in the next year. And while we are at the topic of predictable revenue, in the last years, Intuitive could grow theirs very nicely and steadily. And we see the same in all income metrics like EBITDA, net income, and EPS. Only the free cash flow, which I think is actually the most important income metric for investors, has a bit of volatility with some weaker years. But this comes at least partially from the shift to operating leases, which spreads the cash flow over the lifetime of the lease term instead of receiving it upfront. But again, while this has some short-time effects that warp the results, in the long term, it will also make the cash flow more stable and predictable. So when we jump into my stock rating model, we see that Intuitive has double-digit growth rates all across the board. And that also gives them a pretty good score of 8.2 for 5 and 10 years. Only the EPS forecast for the next 3 years is a bit below the growth from the last years, but with 13.6% expected EPS growth, they still get 7 points here. They also have a very healthy balance sheet with negative long-term debt to EBITDA and a very high interest coverage ratio. So they are in no financial danger. Only the share dilution could be a bit better. I mean, don't get me wrong, a share dilution of 0.8 annually for the last 5 years is not bad, but they are also not buying back shares. But their margin and return of invested capital are very decent, which shows their strong market position again. Unfortunately, while these margins are still pretty good and way above other companies in the sector, when we look at the long-term development, they are also steadily going down. Not by much and not very quickly, but we can definitely see a trend here. The company is not paying a dividend, which only gives them a low dividend score. For 5 years, this is 3.5, and for 10 years, it is 4.1. And if you're wondering why they get a score even though they are not paying a dividend, it is because there is one thing that I think is worse than not paying a dividend. And that is cutting a dividend. It basically doesn't tell us anything about a company's financial health if a company is not paying a dividend. This is just a part of the capital allocation strategy that I admittedly don't like, but that doesn't mean that the company is in any financial trouble. But when a company cuts their dividends or even stops paying one, that is a clear warning sign. In terms of quality, they get a very good score again. They basically get clean 10 points in all but the manager quality that I measure mostly with their capital allocation strategy. And because they are neither paying a dividend nor are they buying back shares, they only get 3 points here. But overall, they still get 8.6 quality score in both timeframes. Last but not least, we have the valuation and momentum score. And here it doesn't look too good. The stock had a negative performance in the last 12 and also in the last 6 months. And they are also trading very close to the 52-week low, which gives them a pretty bad momentum score. But despite this decline, they still have a very high valuation with a PE of 55, EV to EBITDA of 84 and price to cash flow of 56. Even their PEG ratio that puts the valuation in context with the growth is with 2.7 very high. Just for reference, Peter Lynch, for example, considers a PEG of 1 as fair value. Even when we compare the current valuation to their own history, I wouldn't call the valuation cheap. Yes, it is around 10 to 15% below the 5-year average, but when we consider the bad stock performance of the last year, I still don't find it cheap. But at least analysts are pretty bullish on the stock and see an average 1-year upside of 33%. And their minimum price target is basically the price that the stock currently has. So they don't expect much downside risk here. So up to now, Intuitive had quite a good run and could build itself a very dominant position in this surgical robotics market. But the competition has woken up now. The first studies with Medtronic's Hugo in the US were pretty successful and it will probably be released from the FDA still within this year. This robot is already commercially available and being sold in the EU and other markets. And with their modular build and open console setup so that multiple people can look at the screen at the same time, it already shows a lot of promise. First studies even show that the performance in key procedure parameters is the same as Da Vinci's products, but it comes at significant cost advantages. And they are not the only ones. Johnson & Johnson's Ottava robot is also making a push to the market and received the FDA approval to launch human trials last year. So it needs to be seen if Intuitive can defend their market leadership. Don't get me wrong, I definitely think that they have a long way to go. But what if I told you that there is no need to bet on just one winner? Because there is a small and pretty unknown company that has their fingers, or rather their software, in many of these robots. And if you've been following the channel for a while, you probably know who I'm talking about. It's the Swedish small cap Surgical Science Sweden that provides the software and training simulations for many of these robots. Their biggest customer is of course Intuitive, that uses their software in all of the Da Vinci 5 robots. And not only the software to use the robots, but also the simulation software to train how to use them. But Surgical Science Sweden also has their Mimic software and simulation that is part of them in Intuitive older robots, the Symbionics software in Medtronic's Hugo robots that I just mentioned, and is cooperating with Ascensus on their software. In the older reports, I even found hints about the cooperation between Johnson & Johnson and CMR, but this is already pretty old and I could not find any newer info on this. So I am not sure if they are still working together or not. But it definitely shows that they have many contacts and OEM partners in this industry. And this OEM business also only makes up half of their revenue. The other half comes from educational products. Unfortunately, we also see here that despite all these partnerships, their revenue didn't do too much in the last 2 years. This was mostly due to a weak macroeconomic environment in healthcare and headwinds from exchange rate effects. But the shift to the Da Vinci 5 models, and with it a shift to more licensed revenue, has also affected them. Over the long run, they could still grow their finances very nicely. But a large part of this growth also came from the many acquisitions they did to strengthen their position in the market. That is also the reason why the bottom line performance looks a bit more choppy compared to the revenue. With this, their 5-year growth rates are even higher than the ones of Intuitive. The 10-year free cash flow here is actually only the 9-year growth, because their free cash flow was still slightly negative 10 years ago. And as we just saw, it is also a bit choppy. So please take this number with a grain of salt. What I find most impressive is the growth expectation for the next 3 years. The expectation for EPS growth is 37% per year, and the revenue is still with almost 18% annual growth, also well within the double digits. With this, they get an overall score of 9.7. Their balance sheet is also pretty clean, with more cash on their hands than debt in their books. So despite many acquisitions in the last years, they could keep their debt to EBITDA ratio and their interest coverage on a very nice level. Unfortunately, this is not true for their share dilution. This was, with close to 12% in the last 5 years, pretty high. But when we look at the details, we also see that the majority of this was before 2020 already. So instead of taking on new debt for the acquisitions, they issued new shares. Unfortunately, there is currently also no plan to start buying back shares. Their margins are on a little bit lower level as Intuitive's margins, and same as Intuitive, at least the gross and the EBITDA margin also have declined slightly over the years. The ROIC is with only 2.8 very low right now, which is due to the goodwill and other intangible assets that they acquired with their recent acquisitions. So these are largely accounting effects and have nothing to do with a weak business. Overall, that leaves a health and profitability score of 6.4 for 5 years and 5.9 for 10 years. And same as Intuitive, they are also not paying a dividend. What I find interesting though is that in their last annual report, they already discussed that they are planning to pay a dividend in the future. Not in the next 3 years, but in the medium term, they want to return up to 30% of their net profits. Something investors can look forward to. The quality score is with 6.4 for 5 years and 5.9 for 10 years, also pretty similar to Intuitive's. The only difference here, and the reason why they are slightly behind, is the higher customer concentration. Because Intuitive is by far the biggest customer of theirs, they also make up quite a big portion of their revenue, which brings some risks. But where they are equally bad as Intuitive is the valuation and momentum category. Over the last 12 months, their stock went down by 14% and in the last 6 months by 32% even. So the momentum is not in their favor right now. And this has also pushed the stock very close to the 52-week lows. And despite this weak performance, the valuation is also still pretty high. Not quite as high as Intuitive, but it's pretty close. The only metric where they can really shine here is the PEG ratio, where they have a decent 1.2. And remember, this puts the PE ratio into context with the EPS growth. So when we factor in the huge growth, the valuation doesn't seem to be too bad. And compared to their own history, it also doesn't look too bad. While there have been times, especially in 2023, where the valuation was even lower, it is still way below their own 5-year averages right now. So despite the valuation multiples being quite high, they are still decent compared to their own 5-year history. And when factoring in the growth with the PEG ratio, they almost seem to be fairly valued. And that is also what all of the 4 analysts seem to think that cover the company. They give a 1-year price target that is on the lowest side already 36% above the price today, and on the highest side even sees an upside of almost 100%. And this is only on a 1-year time frame. When we compare their scores side by side, first we see that Intuitive still has the higher overall scores compared to Surgical Science Sweden. This mostly comes from a higher profitability and higher quality score, and they're from the higher customer concentration that Surgical Science has compared to Intuitive. This makes them more risky. But the other metrics are pretty much on par. So now is probably a good time to also mention that I am already invested in Surgical Science Sweden and that this definitely makes me biased. I still think that their market position and also their, compared to robot production, CapEx-light software business makes them a great pick if you are looking to benefit from this rising trend in surgical robotics. Their score in my stock scoring system is a bit lower than Intuitive's though, mostly due to the higher customer concentration. And the overall difference is also not that big. I believe that they still have a huge growth ahead of themselves in the next 10 years and that with their many partnerships, they have a very strong position in this market. But they are still a small cap company which brings its own risks and also a higher volatility compared to large or mega caps. So please take this into account before investing. And as always, that's also just my opinion. What do you think about Intuitive and Surgical Science Sweden? Leave your thoughts down in the comments below. And guys, if you are interested in a company that just got huge tailwinds and did already produce 116% total returns in just the last year, check out this video about Broadcom that just got a huge AI push. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.